I'm back with the latest updates and major swings in the Southwest Florida housing market this week, and two stories that may present some prime opportunities for first-time homebuyers and investors who've been waiting on the sidelines in the second half of 2023. Plus, I have an announcement about a special video I've been developing for several weeks now that I'm releasing this Wednesday, and you're not going to want to miss it, so stick around to the end. Now let's get started. Hi, I'm Rick Harrison with MVP Realty here in Southwest Florida, and on this channel, I share tips, tours, news, data, and everything I possibly can to help you decide if this is the right time and place for your next move. So if you're thinking it might be nice to upgrade your life in paradise, then subscribe and hit that notification bell so you don't miss out on the latest information keeping you ahead of the curve. So as I mentioned, I'm going to quickly cover the latest market data and trends in Southwest Florida's housing market, and then I'll dive into a couple potential opportunities for first-time homebuyers and investors coming up in 2023. All right, so this week's market data, we're going to start off, as we always do, with the southern part of Southwest Florida from Cape Coral to Naples. However, I do want to let you know that this last week, on the left-hand side is actually a comparison from the first week of March to this week. So we did have some stuff happen in between. We actually saw stuff go down, and I am going to cover some of that as we go through. But new listings were at 936 in the first week of March. Now, as of this week, which is the first week of April, new listings are back up to 1019. They did decrease 18% about a week ago. So that's where you can see on the right-hand side here under new listings, it went from negative 18% to actually an 8% gain this week. Solds went from no change last time to 66% increase from the last comparison we had. So you can see solds went from 664 up to 1103. And then pendings at the bottom, 1069 the last time we looked at this. That's up to 1224 this time. It went from a negative 7% decline last time, which was back in March, to an actual 14% increase this week. Latest inventory breakdown, single family homes, we're up 248 units week over week. And this is, again, a comparison to a month ago. So it's really a month over month. Condos were up 218. The last time we did this, we had a gain of 319. Now we got a net gain of 466. So inventory is still increasing as we're moving along here in 2023. Multifamilies went down. We lost 20 actually over the last couple of weeks. And then foreclosures, we only lost one. Really not too much changing in either one of those, really. So total sales, this one we actually did see a huge increase this week. 1223 total sales in the last 7 days. Cash sales were 755. That's 61% of all sales in the last week were actually cash, and that is a week over week comparison. All right, and most of these stats, all these big changes are happening because of what's going on in the bond market. Those of you who've been watching me know that every time we go over what's going on in the bond market, I said we didn't really know where things were going. But as you can see, this chart shows where we were back in November when I first really started tracking this. We saw the double top down, and then we've been seeing kind of ride up and down the 200-day moving average, which is that white solid line on the bottom. But as you can see, as of the beginning of March, which is the last time we did this, we kind of hit a new all-time high for the bond market. And ever since then, we can see there's been a huge decline. And now we've actually gone under the 200-day moving average several times. So we'll take a close up here. We got 4 bounces underneath the 200-day moving average, which is showing that the 200-day moving average is really not support right now. And that's actually good news for those of you who are looking to finance your home, because this is what the actual interest rates for mortgages usually track. They usually track the 2 and 10-year bond. This being the 10-year bond, when the bonds go down, that's when the interest rates go down too. So that's why we're starting to see a lot of people start to get back into the market right now, because interest rates have been declining. They hit that 7% range, and now they're heading back down lower around the 6.5% range. But in some cases, people are doing much better than that, into the 5s. All right, northern part of Southwest Florida, Punta Gorda to Sarasota, new listings went from 812 last time to 760. So that's actually down 7% from the last time we did this. And it's really been down since we did this all 3 weeks. Solds 538 up to 994. So 84% increase here. That's a huge increase overall. And then pendings actually just up 5%, 868 to 916. So that's been pretty steady over the last several weeks as well. The solds here, obviously, that's what happened 30 to 45 days ago. So that's kind of a hindsight, and the pendings what's going on right now in the market. So some people are still entering into the market, as you can see, 5% increase, but those interest rates have to go down quite a bit more for a larger number of people to enter into the market. Latest inventory breakdown in the northern part. We had a unit gain of 85 units in the single families and then 157 in condos. So last time we did this, we had a 304 net gain. This time we have a 242. We are still increasing inventory here as well. Multifamily is not a huge change, +6. Foreclosures down 3. Total sales were 895, and out of that, 49% were cash sales in the northern part. That's 443. So you can see there is a bit of a discrepancy between the north and south parts, the inventory levels, as well as, you know, the activity that's going on with buyers in the market and what kind of buyers they are, whether they're cash or finance. The northern part has more finance buyers. The southern part has more cash buyers. So, all right, interest rates. Here's what's going on. And this is what's changed since the last time I did this market update. 6.9%. We were right on the cusp of 7. We were actually over 7 for a couple weeks before that. But now that has actually gone back down a bit. So we have this one is pegging us at 6.8. Bank rate had it going to 6.8 as well. So they're pretty much right on target. But I do know that some people are getting rates near 5, and new construction's even lower than that. All right, let's talk about the evolving events. So I'm not calling it the wave of worry anymore. You'll find, if you watch Wednesday's video, you'll find out why I'm not calling it that anymore. And we're going to be moving right on here to the two stories that I did want to cover here. The first one comes to us from The Real Deal, which is more of a commercial real estate journal. And this particular story is going to have a huge impact on the residential real estate and the markets as a whole, because it's all coming together. And that's what I'm going to be going over in Wednesday's video. But this headline pretty much nails it. Cash flow from Blackstone portfolio no longer covers debt payments. So if you remember, quite a few months ago, I covered Blackstone and BlackRock, how they're different. And Blackstone is really known for a huge rental portfolio. They're one of the largest, I believe they are actually the largest rental portfolio holder. So this one is commercial, but just to bring you through kind of the highlights of this, the loan is still current. So Blackstone has been keeping up with their loan, but the portfolio's declining performance has driven up the loan to value ratio, which, if you're familiar with that, when it comes to residential, you don't want that to happen. That means you're starting to head towards going underwater. As of March, the mortgage's loan to value ratio hit 147%, which a Blackstone spokesperson said was calculated at 127% using the same methodology when the loan was issued. Morningstar data shows an LTV at an origination of 50%. So that's way up, as you can see. The thing that really makes this important is, as of last month, according to Morningstar, 11 properties appraised of value hovered at $214 million, about 60.5% below what it was when their debt was underwritten in 2019. So it's worth less than when they owed it, and they're paying higher interest rates because they had an adjustable rate mortgage or loan on these properties. And obviously we all know federal interest rates went up, which drives up the interest rates that the adjustable rate mortgages will be tacked to. So the remaining Blackstone portfolios should have benefited from the booming rental market in Manhattan for the past 2 years. But of course, we had the shutdowns, we had the extension. So though occupancy dipped to 69% in December, from 99% in 2019, it recovered to 97% in 2021. However, the possible reason here is that the rent collection didn't fare as well. So basically what this is saying is that Blackstone's in a tough spot right now. They're really teetering on the edge of having to get rid of a lot of these properties because they're starting to go underwater a bit, which is probably what's happening to a lot of these big hedge funds who were playing the market and really were, trying to figure out how much longer they could go. That leads me to the next story, which is right from Bigger Pockets. According to recent data, there's now over 1 million multifamily units under construction, the highest ever recorded, many which are ready to hit the market this year. What does that mean? So we got a slowing market. Buyers are not stepping into the market as they like they were the last 2 years or 3 years, really. And on top of that, we have the highest amount of units, multifamily units under construction. So, first, rent has been getting driven up because, there was more demand than there was actual inventory, right? But now with a huge flood of inventory coming to market, that's going to drive rental prices down. In addition, if interest rates keep declining, which it looks like they're going to since the 200-day moving average has been broken several times now, if those keep going down, that's going to have more buyers enter the market right at like the almost the imperfect time for multifamily builders and for all these portfolios that are holding all this real estate. So it's going to be almost a perfect storm, possibly for the real estate, both in commercial and residential. And that's where this opportunity comes in for you home buyers, or those of you who are looking to be first-time home buyers, or even investors. If these waves of inventory come for rental units, you might be able to pick up some pretty decent priced homes. And if you're a first-time home buyer, house hacking, which if you're not familiar with it, house hacking is you buy a multifamily home, live in one side, rent out the other. There's a few different ways you can do it, and different ways you can, finance it. But essentially, you live in one side, and while the other side is paying most of your rent, if not most of your mortgage, if not all of it, helps you save money. You're helping somebody else have an actual place to stay and place to live for a reasonable price. So that's great for first-time home buyers. And then investors, obviously, you might be able to pick up some of these properties, 77 cents on the dollar kind of thing. So that's all coming to market, and we'll have to see how it plays out. But I'm pretty optimistic about what's going to happen for those of you who have been sitting on the sidelines, and interest rates actually going down, with the Fed probably having to pivot or reverse course now. So, like I said, there appears to be some great opportunities coming soon. And if you have questions on how you should be preparing or what you can be doing to better position yourself, let me know in the comments or reach out to me directly. My contact info is in the description and the top comment as well. Before I go, I wanted to let you know about a special video I'm releasing this Wednesday that I'm pretty excited about. I've spent a lot of time researching this subject, and it's going to be a little different than what you're used to getting from me, but it is going to explain the Great Reset, why our financial system is collapsing, and where things are heading next. So if you've been wondering about what the Great Reset really is, why we go through recessions, how currencies change, and what the heck is going on with the economy lately, then tune in Wednesday at 6 p.m. I hope to see you there, but until next time, stay safe, stay positive, and more importantly, stay free.